focusing in on the currency as well as the overall macros with Shubhda Rao, Chief Economist at Yes Bank, who now joins in live. Thanks very much for being with us, Shubhda. To start off with, what are your expectations from the GDP numbers and how do you believe bond yields will trend?
I think as far as GDP is concerned, we still believe that first half would continue to show a laggard kind of impact of all the macro adversities that we did face. So the second quarter GDP would be somewhere around 4.6, where we do anticipate that agriculture and services would provide some decent support, but it's the manufacturing or industry that would be sub 3%. So if I were to disaggregate, agriculture could come closer to 4%, services closer to 6%, and as I said, manufacture would be under 3%. Overall, I think it's only the second half that we expect some ramp up in economic activity, probably more closer towards the last quarter, starting from say November or December, because we have seen the lagged impact of what happened in global headwinds, domestic interest rates, and the slow pace in terms of the clearance of projects, etc. All these would begin culminating and manifesting in headline numbers getting a little bit better closer to the December to March time frame. So second half, we're looking at say 5.5% growth in GDP. For the full year, we would be at 4.95. So it's still a very tepid pace of recovery that we expect going forward.
The forex swap window will be closing November end, and despite a firm global cues, the rupee is seeing a little bit of weakness today. How do you see the rupee panning out in light of the forex swap window?
I think essentially, rupee is going to be taking cues from what's happening on the taper talk, as well as what's happening domestically. As far as the domestic concerns are concerned, I would think that a large part of the current account deficit worries have waned. We have bolstered our forex reserves up to the tune of 25, maybe up to $30 billion. I think that's a fair ammunition. So to the extent the pressure on rupee could largely come from the global cues, particularly, as I said, taper talk. In our opinion, I think the actual taper would begin, the probability is more in March than in January. But in the near term, we will see some kind of narrow band volatility between, say, 62, 64. It's unlikely that rupees will show any signs of strengthening beyond 62. And even for the weakness in rupee above 64, I think there would probably, a cue waiting somewhere in another bout of volatility in the global marketplace. But by and large, I would think 62 to 64 would be the safe trading range that we would anticipate in the near term. As I said, a lot depends on how and when does the taper begin. So the differences are somewhere whether it starts in January or in March or in December. We believe the best bet could be in March for the taper actually to start, that too in a very measured and calibrated pace. So rupee, there would be spikes either on a weaker or a higher trough along the trend, but broadly within 62, 64 is what we anticipate the rupee trading into.
How do you anticipate the inflation numbers to look like, Shubhda? I mean, vegetable prices seem to be on a tear. They don't seem to be coming down. And that probably could have a bearing on what the RBI does too. But just the next couple of inflation readings, how do you think they'll look?
I think that's a good point because, at this point we were reeling under a fresh bout of price pressures over the last 2-3 months. Our sense is, as far as the CPI is concerned, we could see one more reading of around 10% despite seeing food prices ease. Let's not forget, every good monsoon year we see food prices easing beginning November. However, the overall momentum seems to suggest that even if you look at a month-over-month momentum easing to say maybe a 0.3%, but the annualized number on CPI may still hover close to around 10%, not exactly giving comfort to the Reserve Bank of India. Coming to the wholesale price indices, I would think that, once again for the next 1 or 2 months, we could see the WPI inflation hover close to 7% or a little over 7%. So if I were to give a kind of a 3 or 4 month outlook, the sense we get is the prices would begin to ease in terms of annual inflation would begin to ease starting January and February. So what would it have for RBI to take in terms of input for shaping the monetary policy action? The sense that we would like to go with is RBI may skip the December rate hike, and we have penciled in one more rate hike, which is of 25 basis points. It could come sometime between January and March. But I think it's very essential to also keep an eye on what's happening to growth. For instance, the very latest data that we saw today was on electricity generation for the month of October, and from a 12% plus, the electricity generation has nosedived to just around 1.2%. Now, what does that do to the IIP in October would definitely be something that one would ponder over and worry about. But yes, the recovery that we were anticipating from starting October, November, probably we will have to wait it until wait it out until November or December. So the coal generation, electricity generation, I think all these become very important in also being supportive of manufacturing sector growth. We need to, of course, ascertain whether it's a one-off dive in power generation or there are some more structural features attached to it. But the news on electricity generation for the month of October is not very good, particularly if we are looking that as being supportive for manufacturing sector growth. So early days yet, but yes, we do see some small traction in the overall growth. RBI may or may not, we believe that probably may wait out of the December policy on 18th and may take a rate call sometime in January. We still see one more rate hike, as I said earlier.